Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight are Graeme Körner from A Körner Perspective and Zwelakhe Mnguni from Benguela Global Fund Managers. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Let's get straight to the questions because there are many of them. Firstly, should one still hold small and mid-cap sector? If I'm not incorrect, I've heard people saying that when the prospects of the economy start getting better, that's actually maybe where you should look for opportunity. Zwelakhe, is that the case or not?
Yeah, look, I think small caps tend to be under a lot of pressure during the hard times in the economy. But when the economy improves, they tend to also benefit. They get more growth opportunities. They tend to be a lot more leveraged to growth than the bigger companies. So I would certainly be in favor of that kind of thinking.
All right. And on your side, Graeme, I mean, just particularly one counter that is in that space is Zeda, the mobility company. What's your view to enter Zeda at these levels as we approach summer? Should the fact that we are approaching summer be filtering through to your decision on entering Zeda at this point, Graeme?
I don't think it's really just a seasonal thing. I mean, obviously, we've spoken many times about disposable income being under pressure. If you look, for example, recently at the results out of City Lodge, they looked a bit better. So, if you think about tourism, maybe as a driver for them could be quite good. But I think the reality is in South Africa and globally, disposable income is under pressure, and I think that'll hurt the likes of Zeda. But I don't truthfully have a strong view on them.
All right. Well, gents, so let's go into Prosus. Your view on Prosus after the recent correction. Is it a buy? I actually don't know how much it's been affected by this narrative that's going on that the Chinese stimulus rally has lost steam. Zwelakhe, Prosus?
Maybe I need to just build a foundation for myself on that. I still think that I mean the largest or the biggest value in Prosus is essentially Tencent, and I still believe that Tencent is a good business. It's got great prospects. It's continued to integrate more and more services on its platform. So I think I'd be in favor of Prosus at these levels. However, I do think the market did get ahead of itself with this whole Chinese stimulus rally. I didn't even get an understanding of why the market was getting excited. I mean, it was a bit more of a relief on the consumer, and it had no major implications for the overall economy of China. Or it does in the long term, but it didn't. What was priced in was way too much.
Yeah. So at this point, it's just sentiment rather than actual real numbers and real impact. I mean, Prosus has run pretty hot since mid-September. It's had a little bit of a pullback, but I mean, not enough to cancel the rally that we have had since mid-September. Your thoughts on that, Graeme?
Well, we've always said we prefer Naspers because you get the double discount. So, if and I agree with Zwelakhe, I think, Tencent is a good asset. You get everything else plus some for free. So, particularly if you buy Naspers, but, it ran from, 3.5 or thereabouts to 4.4, as Zwelakhe said, really just on, I suppose, almost the market being caught flat-footed after being so bearish for so long on China. And yeah, I think a bit of maybe a bit of short covering, a little bit of euphoria setting in. Of course, Chinese markets have been closed for a little while, so they were kind of playing catch up. So if you look at the major indices there, although they might have been up, you saw Hong Kong. I saw one headline that described the Hang Seng as behaving like a penny stock, as it was over 10% today at one point, and I think it closed, as Zwelakhe can maybe help me, but I think down 9.4%. So, and obviously that affects the likes of Tencent and Prosus and Naspers. But I think the short answer is, if you want Prosus, I'd ask the question, why don't you just buy Naspers? You're buying it at a discount, firstly. Secondly, I agree with Zwelakhe. I think the market was a little ahead of itself, and that's probably why Hong Kong had a little bit of a temper tantrum today, because the market sort of feels, okay, well, you've given us some broad stimulus, but we need to really see you throw the kitchen sink at it. They didn't get that today, and I think that's in large part why the Hang Seng blew off quite a lot of steam today. So I wouldn't rush out and buy a Prosus or Naspers for that matter, but watch it. It seems to have formed a new trading band, and these current prices are definitely at the upper end for both of those stocks.
All right. Well, talking about steam, seeming that for the month of October, FirstRand, and actually the last week of September, FirstRand has started losing a little bit of steam there. There's a question here: is it too late to buy the FirstRand shares now? Talking about the fact that it has lost a little bit of steam, Zwelakhe, would you maybe look at this as a buying opportunity for FirstRand?
Yeah, I think long term, FirstRand has always been a good business to own. They're innovative. They are very well managed. I would think even at these levels, there's still potential for them to add some value to shareholders through the growth in the economy.
On your side, Graeme?
I think the easy money has probably been made in the likes of FirstRand. As like he says, it's been brilliantly run for a decade, and it was really the bank to own. So, while maybe some of the other banks were more focused on expanding into Africa, for example, and a few of them maybe scoring a few own goals, FirstRand kind of didn't put a foot wrong. They just built on the franchise and went from strength to strength, and they've been rewarded with the highest rating of the group. So I think from my point of view, I wouldn't be buying FirstRand right now, because I think the reality is, if your hypothesis is because what's good for FirstRand is going to be good for Absa, is going to be good for Standard Bank. I think what we need now is the environment to be a little bit more friendly in terms of lower interest rates, a little less pressure on consumers and borrowers, and that's good for all the banks. So I would then just frankly say go and buy the cheapest of the lot, which by some margin is Absa. But I do think that Zwelakhe is right. It's been the best run, but you're paying a big premium for that, which I think is excessive considering the realistic prospects of all the banks over the next sort of 2 to 3 years.
Well, going still in financial services, going into short-term insurance, there's a question here on Outsurance. View on Outsurance: it is flying. That is with lots of exclamation marks, and it really is. And if I remember correctly, they had some good numbers out in their most recent update. Zwelakhe, your view on Outsurance, and of course looking at the fact that it's flying, do you think that there would still be an opportunity to go in?
I've been so wrong so many times. Look, I think they are at a premium compared to other insurers. They traded high multiples, but I think they've proven, even with the last result, they've proven why they traded a premium. They're well run. Their direct model compared to the agent-driven model, I think has delivered very good results, has delivered very good returns for them. Yeah, it's hard to say it's a sell. I'd probably say short term, I wouldn't buy it. But if I'm thinking long term, 3 to 5 years, I'd still buy it.
Outsurance, are there, Graeme?
Frankly, it's not as though we intensely like or dislike any sector, but I think one sector that I am a little bit worried about in terms of the future is short-term insurance. I think Outsurance is a brilliantly run business. I think the model works. But I think for me, I'm worried about, you've seen, for example, hailstorms, then you have floods, then you have fires. We're seeing more and more of these sort of almost once in a lifetime events happening quite frequently. And I think it's going to become very difficult in this climate change environment for insurers to actually manage those risks. I think generally it's going to be a case of people are going to have to assume more liability for themselves, but I'm worried about the whole short-term insurance sector if I take a strategic sort of a very long-term view. But I think what Zwelakhe is saying is probably right, that they're trading very well and the market's rewarding them for that. So the question about whether you buy something that's had a hell of a run, generally I don't. I sort of say, okay, well, there's probably quite a lot of good news priced into it. So I would rather just sit it out. But as I say, long term, I am worried about the impact of climate change on that sector.
Yeah, all right. Well, let's go.
I think the
Yes,
sad thing,
Zwelakhe?
Graeme, is that I was just saying that the sad thing is that we are going to pay for it. So they'll come back to us and charge us more.
Yeah.
Even if the insured population shrinks, they'll increase the pricing.
Yeah, I hear you on that. I hear you. Well, let's go into telecoms before we go into the before we go into a break. There's a question on MTN. I've held the stock for more than a decade, and it has been a disappointment of note. Given MTN's exposure to Iran, Yemen, and Sudan, together with currency headwinds of Nigeria, is it time to give up? Actually, what's happening with that exposure to Iran, Yemen, and Sudan? Are they not out, or I struggle to keep up with the regulatory movements there. Zwelakhe?
Yeah, as far as I know, I mean they out of Iran. I could be wrong, but the bottom line is MTN has struggled not so much about Iran and the exposure to that part of the Middle East. It's actually been Nigeria that's taken wind of their sails. They had the Nigerian currency devaluation was huge, and it hit MTN on two fronts. One, the revenue and profit that they generate in Nigeria, when you translate it into rents, it's become insignificant or less. And secondly, they buy infrastructure on the basis of dollars, and the more expensive or the weaker the naira, the more dollars they need to buy it. So it hasn't been a good investment, primarily because it was a good investment because of Nigeria. It's now no longer a good investment because of Nigeria. That's certainly where we stand with it.
The cure is the cause. The viewer had said, Graeme, that he's been holding the stock for a decade and it's been quite a disappointment. Does the viewer hold for hope of a better future for MTN, or just get rid of it?
No, I think what Zwelakhe said is right, that the crown jewels have actually become in a way the weight around their neck. I have a slightly different take, and in spite of what I said about we don't hate sectors, telecoms in South Africa is another sector that we're not mad about. And I think one of the reasons that, and I think what Zwelakhe is saying is right, that you've got dollar-based costs and you've got revenues in naira and rands and a whole lot of other emerging currencies. But my concern is a little bit more fundamental than that, and that is that the days of them selling airtime at R2.50 a minute and data for 150 Rand a gig are in the dim and distant past. I think they still dream of those days. The world has kind of caught up with them. The number of people who in normal business now call you on WhatsApp and send messages via WhatsApp, the whole world has changed for them. And you've seen it, for example, in the deals that they are offering customers. So my concern is actually more around the business model, around traditional voice and data. I do think there's some optionality if I think about the fintech business, and the same is probably true, or not probably, the same is true for Vodacom. But my worry is that it's going to take time for the other services and fintech to make the kind of contribution that they're going to lose, in inverted commas, from the traditional voice and data businesses, remembering that as people's contracts expire, sometimes they just stay on a month to month without realizing it. And then when they do renew those or roll those or go over to pay as you go, it has a massive effect on the revenues and the ARPU. So my concern is a little bit more fundamental. Having said all of that, I think at sort of $85 or so, it's down so heavily that there is some optionality. They are getting out of quite a few of the peripheral markets, and they're facing their demons. Obviously, they've done deals around the towers. So I think if you've come this far, my sense is there's probably a bit of optionality in it. But I would say have a good hard think about the long-term prospects for that business, and if it's a business that you actually want to be in. And the same is true, frankly, for Vodacom and Telkom as well. So, but I do sense that there's a little bit of upside. You can go from probably 85 to 110 on fairly little good news, because there's just so much negativity baked into the sector.
All right. Well, quite an interesting question here. With stock markets being at all-time highs, what percentage of your portfolio should be in cash in order to take advantage of a potential stock market correction? Currently, I have around 10% in cash. Would this be considered acceptable, or should I try and increase this by selling a few shares? Zwelakhe, 10% of cash, is that acceptable? But also, would it be a good idea to be selling shares at this point?
Sounds like the viewer wants to time the market, and nobody has ever made money doing that. But I do think that if you are invested in stocks, I mean, you almost have to run the portfolio at all times at maximum. I wouldn't keep more than 3% in cash. And that's a choice you've made, that you want to be in the market, and you have to keep that money there, because to think that you can time it, I mean, something happens and you could miss out on a big rally while waiting. So I'd say trim the cash down to 3% at any given point in time.
Graeme, I want to come to you with ARC Investments, so African Rainbow Capital. It has had some positivity recently, going above the R7 mark. Is it time for it to finally rally, or is this momentum just coming from the 25% acquisition interest from Sanlam? Graeme?
I think what's driving it is probably the same as we've seen it in a couple of other sort of unloved SA stocks that either traded at deep discounts to NAV if they were investment holdcos, or to intrinsic or fair value. So I think it's really just gapped that up. But I think maybe the thing that really lit a fire under them is time, because I think there's quite a lot of excitement around the optionality of time. But I think if I look at this thing over a 1-year view, it's up about 30%. We like the story very much. I think it's the third biggest holding in our fund. Because it's not just the discount to NAV that we like. And I'm very happy to debate the valuation of Rain, although I think in spite of everything I said about MTN and the telecom sector, I think Rain is somewhat uniquely positioned. But great assets in the form of time, great financial services portfolio, businesses like crops, really, really exciting. So, it's not just a 40% discount to NAV that attracts me. I really like a lot of the underlying. Obviously not everything, but 95% of what's in that portfolio we like. So, to expect a massive rally is maybe a little bit much. But what we are seeing, because we hold quite a few of them, and we let's say love the stock. One thing that is important is the liquidity. In spite of the fact that it's an 11 billion rand market cap, the liquidity is abysmal. I mean, at the close today, the best bid was 710 and the best offer was 742, and you often find it moving sort of 20 or 30 cents. So I think that the register is probably tightening up. The company and management have indicated that they would like to see that discount narrow. So I think it's one of those that the upside is quite significant and the downside is probably quite limited because of the visibility in the portfolio and the confidence that management team have in the NAV.
All right. We're talking about confidence, seeming that there isn't much in the PGMs at the moment. So there's a question on Amplats. View on Amplats on PGM miners at current levels looks very cheap. They have been looking cheap for a while, Zwelakhe.
Yeah, look, I think they have been overvalued for a while, that those PGMs to some extent. If you look at what was happening in the last little while, and I'm framing this because people look at the share price, where the share price was, and look at today, and sometimes what was the underlying it down was ridiculous. So the PGM prices have gone too far and to an unsustainable level, and these stocks are now pulling back to more reasonable levels. I certainly like Amplats at these levels, but I'd say that the what we saw in the past is gone, and we need to think about the reality today. Electric vehicles are taking over, and they will put demand for PGMs under pressure unless alternative use is found.
Well, another interesting question. Any reason for the decline in Anglos today? Of course, a lot of the declines, well, actually just the broader, came from the broader resources complex. But also so just on the decline today on Anglo American, but also my question, Graeme, to you as well, is with Anglo letting go of Amplats, I mean, can we still expect Amplats to have as much of an impact on Anglo American, even though investors know that, they are unbundling it?
So I think that the future of the two companies looks different, and I think you saw Anglo selling 5% in an accelerated book build, help me Zwelakhe, probably 2-3 weeks ago, and they managed to put away a fair block at a good price quite quickly, which tells you somewhat ironically that it's that there's appetite for it. I actually think that Amplats out of Anglo stable as long as they have access to the funding, and arguably if you then have, let's call it a proper free float of investors that are really supportive and they're in platinum or PGMs because they want to be there, I think it could be quite constructive for Amplats. I think what Zwelakhe was saying around electric cars is right, but you're also starting to see, ICE engines, demand for those starting to pick up, and you've seen a couple of the automakers sort of kick out their all-electric plans. And of course, there are other technologies that would use PGM. So I think the PGM cluster generally has actually been quite soggy, particularly platinum. Obviously, palladium with the Ukrainian invasion went through the roof, but subsequent to that, those markets seem to have settled down. I think this is not for widows and orphans. This is for people who can take volatility and don't cry. I think Amplats at these levels looks like a very worthwhile punt. Ironically, once Anglos is out and Amplats is standing on its own, it'll probably become a reasonable index play again, which will probably attract some tracker funds. I know they've fallen out now, but they'll re-enter. I think the one that might be vulnerable after all of this is Anglos, because then all that other stuff that made them unwieldy and potentially unattractive is gone. It's then copper, iron, or all the juicy assets that the likes of BHP and Rios and Glencore are interested in. So my personal hypothesis is Anglo's fast track 4 or 5 years will probably be taken up by one of the other majors, and Amplats will probably be a stronger company with, let's call it more dedicated shareholders who maybe support the long-term vision and will fund it.
All right. Well, talking about vision, gents, let's get to your stock picks for today. Zwelakhe, what are you picking?
Yeah, I'm going with Microsoft. I think their stock has come under quite a bit of pressure. I mean, the market has been disappointed with its artificial intelligence capabilities, but I do think that if there is one company that's going to be able to build capabilities around artificial intelligence, it's Microsoft. And I think that the pullback from over $460 has given one an opportunity to maybe consider it at these levels.
All right. Graeme, where are you seeing opportunity right now?
I'm going into the UK and buying or recommending a company called Diageo, which is effectively a spirits business. They've got a little bit of beer and so on. But great portfolio of spirits, global brands, obviously the likes of Johnny Walker, lots of single malts, lots of regional brands. If you look in the US and Canada, for example, it's just an absolute powerhouse. You know, it's come off quite sharply of late. Obviously, disposable income inflation hurt consumer spending, particularly in Latin America and the Caribbean and in places like Mexico. Yeah, so if I look at this business, I think it's fundamentally quite defensive. You listen to management, very, very clinical around costs and capital allocation, but at the same time being quite visionary about, for example, doing with tequila, crazy as it sounds, with what they did with Scotch. So I think there's quite a lot of optionality on the upside, and at its core, it's actually quite a defensive business, and it's very much geared ultimately long term to the emerging wealth in, you know, in the developing continents, in Asia, particularly, I think in places like China and India. So I think it's a very, very well-placed business, and it pays a pretty decent dividend yield as well, around 4%. So I think Diageo at sort of £25 to me looks very tempting.
All right, well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Graeme Körner from Körner Perspective and Zwelakhe Mnguni from Benguela Global Fund Managers. Up next, The Close. Stay tuned.